Hello everyone, welcome to this Forex trading class. My name is Precious Olidare and I'll be your tutor and I'll be walking through your trading journey. So our first class today will be basically introduction to what trading is and just make you familiar with some trading terms. So work with me. I will employ you all to get your jotter and pen to jot some things down because there's going to be a task for you after this session. So let's get right into it. So what is trading? Trading is basically just buying and selling in layman's word. So when we relate it to the financial market, trading involves buying and selling of financial instruments. And when I talk about financial instruments are the assets that is traded on the financial market, which are like the stocks, the bonds, currency, and commodity to make profits. So I'll be breaking it down as we go further. So while trading is a side activity to some, others make it their primary source of income. So trading could be a part-time business to some, while some other people just go fully into it. It can be a full-time source of income and it can be a part-time source of income. So this book is going to introduce you to the basis of trading and will take you to those and help you to take the first step into the exciting and potential lucrative world. So this is a very lucrative business and you should be patient in learning everything that it is about first. So that's the first step. The first step is to learn, and that is why I commend all of you for taking this decision. So what is trading? We'll start with defining trading properly. So trading refers to buying and selling financial instruments within a short period to profit from price movement. It's just like you predict a price movement. It could be you predict that a market is going to buy or you're going to sell it or is going to sell for a short period of time, and then if your prediction is right, you make money from that prediction. So unlike long-term investing where assets are held for years, trading aims to make quick profits. So there's a big difference between trading and investing. So when it comes to trading, you're predicting the price movement within a short term to make profit, and it is aimed at making quick profits. But when it comes to investing, you are predicting the market movement, and it's more like you're just putting your money in an asset long term. No matter the ups and downs, it's just to preserve your wealth, and you make money from the increase in price of that asset. So let's go into it proper. So I'm going to give you some difference between trading and investing to make you understand better. So we'll define it based on the time horizon. So traders who hold their position for from seconds to a few months, they are traders. So when you profit from price movement when you profit or lose from price movements in the market within a day, within seconds, minutes, hours, within a day, within few days, within a week, or within a month, you're considered as a trader. But to be considered as an investor, it means that you're holding an asset for a very long period of time, like years or decades. So that is what investment is about. So I'm going to talk about risk management. So when it comes to trading, traders use stop loss orders and other techniques to limit their losses. So there's a concept called the stop loss concept in trading, where short-term traders basically use to limit their losses. right? So it helps to divine the amount a trader is willing to lose in a trade. But why investors rely more on fundamental strength of the company, investor would most likely look at the financial data of the company, to just those are fundamental information, and to know if the company is, you know, is doing well, and they might decide to just leave their money in the company just for that reason. If the company is doing well, they look at the financial data of the company, like the EPS growth, their earnings per share ratio, and so many other things, their peg ratio, their PE ratio. So those are the other things that the fundamental entails, and people who are looking to learn about investing and the stock market could focus on getting to know more about that. So, and also the types of analysis. So traders generally, be it day traders, be it swing traders or position traders, they focus heavily on technical analysis. So when you see your screen like this, there are different type of technical analysis anyways. So, and for example, chart movements and everything, like, okay. So what I'm trying to say is that traders focus on technical analysis to make their decisions, right? So they could analyze a chart and maybe an assets, for example, is at $5, and they could predict that it's going to move up to like $10, and they could decide to buy it at $5 and risk it. And when it's, move up to $10, you make money from the price movement. So traders focus heavily on technical analysis. So you will see some, so as I've said earlier, there are different type of technical analysis. So you can see people using lines on their charts, drawing lines, people using indicators, and chart patterns, a lot of technical analysis, and we're going to get into that. Why investors, they prefer fundamental analysis, like I've said before. They would focus on the fundamental strength of the companies, and the fundamental analysis now is looking at the company's financial strength. You look at the general economic, how the economy is performing. You look at the inflation rate, the interest rate, and so on. So that's the fundamental analysis, and that is what investors focus on. So moving forward, I would like to talk about some key terms and concepts when it comes to trading. So the first one, we'll talk about the market types. So as I've said earlier, that there are different kind of instruments that are traded on the financial market, and I'm going to be explaining different markets that are under the financial markets. Some are listed here. So I will be starting with the stock market. So the stock market is a market where shares of companies are traded. So when you hear the word stock, shares, it has to do with the stock market. And for example, we can say, okay, I can decide to buy a share of a company. I'm going to use example, a Nigerian company like Nesto, right? Or yeah, like Nesto. So I could decide to buy a share in Nesto company and hold it for a long time, and I could base my analysis on the strength of the company. How is Nesto doing? Are they like, as the financial reports okay? Can I put my money? Is there certainty that I would my money will increase? Can I put the money in it for like 2 years or more? So that's what's like stock market trading is. And I could use another example that we are all very familiar with, like Apple. I think a lot of people use Apple products. We have Apple iPhone, Apple Watch, and all that. So uh, Apple currently is about is around why is it not clicking? Like your mouse is not clicking. Okay. All right, let's move on. So I was talking about the stock market and what is traded in the stock market. That is the shares of companies. And I was going to cite an example with Apple shares, and I was going to show you the screen. So this is the Apple share, and this is the represented on the chart. So the current price of Apple is 195. So I could decide I want to buy this, let's say one quantity of Apple share today at 195, and decide to hold it for let's say a year. And after 1 year, that has increased in price to about 300, or let me say 500. So after 1 year, I would have made like $300 from this Apple share. And if it's if it's good the other way around, that's at the end of 1 year, the Apple share is now around 150. I would have lost about maybe $40 on this share, on this stock. So that is what investing is all about, right? So moving forward, I will talk about the forex market. So in the forex market, a different instrument is being traded here, like different from what is traded in the stock market. So in the forex market, also known as the foreign exchange market, we trade currencies. So different country trade their their their, their currency, like different countries' currency is being traded on the forex market. So example of currencies that are traded on the forex market, we have the Nigerian naira, the United States dollars, the Great British pounds, the Australian dollar, the Swiss franc, the Japanese yen, and so on. Yes. So another type of market is the commodity market. So in the commodity market, physical goods like gold, oil, and agricultural products is being traded. So you don't actually have to like have those physical goods to trade in the commodity market, right? Everything is being, there's a site where you can just, trade. Everything is represented in a chart. And you can buy gold and just, predict that it's going to like increase in value, and you could earn from the increase in gold. And you can predict that gold will be selling for a while, and then you can short it and make money from the sales of gold. So that's, and there are other physical goods you can buy and sell in the commodity market, like oil, agricultural products like cocoa, and so on. So, and the last but not the least, okay, the last type of market that is here is the bond market. So we're trading where debt security, is being traded. So in the bond market, debt security is being traded. If you have ever heard of government bonds, so it is traded in the bond market. So moving forward, I will talk about type of orders. We have other types, yeah. So don't be afraid if you're not getting it straightforward. Each of this subtopic will be treated as individual topics, and you will get more detailed explanation on everything. So I'll talk about other types briefly. So what I mean by other types is that the types of way you can place your order in the market. So the first one I'm going to talk about is the market order. the immediate purchase or sales at the current market price. So that is what we call the market order, and I'm going to give you an instance. So example, you want to buy an asset, or you want to, let me say you want to buy an asset, and you want to buy it right now at the current price. So that's what we call the market order. So at the current market price, you can just click your buy or sell button, and then your order is being filled immediately. So the second one is the limit order. So is the purchase or sale at a specific price or better. So you want to, example, you want to sell a okay, I'm just going to skip using buy so that you don't get so confused. So you want to buy a specific asset, let me say you want to buy an asset at a specific price. You don't want to buy it at the current price. You want it to get to a certain price before you buy it. So you could use your limit order. So all those things I will show you later on how to make use of them and where you can find them. So you could set a limit order, and it will get filled when the price gets to that point. And also we have the stop loss order. So it's the automatic sale when the price reaches a certain point to limit losses. So I'll give you an instance. Assuming you have $100 in your account, in your trading account, and you decide that you want to risk $10 out of your $100 on a trade, and then you risk that on a trade, and then you have a stop loss placed right in your trade, and your risk is $10. So when the market gets to your stop loss, assuming the trade didn't go in your favor, so you're going to be losing $10. So instead of losing more than that, your stop loss order has saved you, has helped you cut the losses. So you could have lost more than that, right? You could have lost the whole $100, but your stop loss order is just like your protection. Like, okay, you set a limit that the market would reach if a trade does not go your way, so it will help you limit your losses. So that is what a stop loss order is. So at the point where you lose $10 out of $100, you will still have $90 capital. So I will also talk about leverage and margin. So these are the terminologies that you would be hearing a lot. So I don't want it to look so strange when in our further class, when I start using these terminologies, and I don't want you to be lost. So that is why I'm trying to explain those terminologies in the simplest form as I can. So when we talk about leverage is simply using borrowed capital to increase your trading position. So you're leveraging with what you have to get a larger capital. So leverage is, you can decide the size of leverage you want to use when it comes to with your broker. So there's different leverage that you can use. We'll talk about that when we are talking about brokers and how to open your account, the type of leverage to use. So, and we will talk about, and the next thing here is margin. Margin is the security deposit required to cover the borrowed capital. Margin is just the amount you're depositing that is required to cover the leverage, which is your borrowed capital. So we'll get into that deeply going forward. So briefly, I want to talk about trading strategies. So as I've mentioned earlier, there are various types of trading strategies, but let me take it step by step. First and foremost, I want to talk about day trading. So day trading, by definition, is buying and selling of financial instruments within the same day. So you predict the price of the movement of an asset within a day. You buy or sell, and then you close it within the same day. So that's what we call day trading. So you see people saying, "I'm a day trader." It means they profit from the short market movement within a day. So, and the advantages is that there's no overnight risk, because when you hold the trade overnight, there are some fees that are being charged, so you don't have to be bothered by that, and you get to take your profit quickly. So the disadvantages of day trading is that you have to be committed. You have high time commitments. You have to mostly be in front of your screen every time to look for opportunity to monitor your trade. And because it's just a short term trade movement that you want to profit from, and there's high transaction costs. So the second type of trading is the swing trading. So those people who swing trade, they call themselves swing traders. So by definition, they are it's just holding position for several days or weeks to profit for short-term movements. It's still a short-term trading, but it's just longer than day trading. So you hold trade for several days and even weeks. It can be even for weeks to profit from short-term movement. So the advantages is that there is a less time commitment than day trading. You don't have to always be on your screen. You can execute today and just leave the market alone to do its thing. You don't have to be constantly monitoring your trades. So because your intention is to hold for days or even weeks. And also the potential for larger profits. So as a swing trader, you are like you even earn more because you're patient and you're holding your trades for a longer time. So there's a potential for larger profits. So, and disadvantages is overnight risk. Like you tend to like leave your trade alone overnight. You may be charged some fees and a larger price movement against your position. So if you're swing trading when the market is going against you, you tend to like lose more, right? So we also have position trading. By definition, is holding position for several weeks or months based on long-term trends. So you just position trading is identify the trend. You just hold for several weeks or months on a long-term trend. So you are trying to like profit from the whole direction of the market. So that's why it's called position trading. You're trying to catch a whole trend. So you can have to hold the trade for several weeks or months. So advantages is less stress. You don't have to stress because you're trying to like catch a trend, a long-term trend. There's less time commitment. You don't have to always be in your screen. You don't have to stress, and there's potential for larger profits. Like there is larger profit when market is going in your direction. And the disadvantages is long waiting period, potential losses during trend reversal. So you have to wait for long. You have to be patient because there was going to be market ups and downs. So you get to see different stages that the market could be in: the accumulation, the consolidation, and the breakout phase. You just have to wait through all those movements, price movements. So you just have to wait, and there's potential for losses during trend reversal. So if the trend, if there's a change in trend, you could lose your money. You could lose more. Yeah, you could lose a large sum of money. So also I'll be talking about technical analysis. So, technical analysis, I told you this is what traders rely on to make their, their predictions. So, I'll first talk about the basic one, which is charts and time frames. So, chart is basically the virtual representation of price movements over time. So, this is an example of a chart. As you can see, you'll be seeing some candlesticks, green and red on my screen. So this is the chart, and there are different other things you can use to represent these charts, like lines and all that, like candlesticks. We can use lines, yeah. So this is your chart. You can use column and all that. There's just a lot of things here. We'll go into that later. I'm just trying to introduce you to them. So let's continue. And also time frames. Time frames is also a technical, or a tool we use in our technical analysis, right? So there's different time frame, like the minutes, hour, day, and weekly charts. We even have more than that, like the monthly chart, the yearly chart, 6 months chart. So this is where you can see your time frames, even from a tick, 100 tick, and seconds, minutes, 5 seconds. So this is, everything is here. You can see your, so it's just that this, whatever you choose here, it is representing. Let me start with the seconds. I choose the, okay, I can't, I don't think I can. Okay, I can access that. Okay, 1 minute. I can't access the second, this because this is a free trading view. It's not premium. So this each candlestick you are seeing on my screen now is representing 1 minute, because the chart is on 1 minute time frame right now, and 2 minutes. Okay, 3 minutes. I can only access 3 minutes. So each candlestick you can see right now it represents 3 minutes. Chart movements within 3 minutes. So every 3 minutes it changes. There's always a new one forming. Let me just go to the 1 hour, because I don't want to talk much on this right now. And 1 hour, each candlestick you can see on my screen right now, it represents 1 hour time frame. So each 1 hour there's a new candlestick being formed. So it changes every 1 hour. So each candlestick on my screen represents 1 hour. So that is all about time frames. We will talk deeply into that in our subsequent classes. So another type of technical analysis, another tool we use it for our technical analysis is indicators and oscillators. So indicators are tools we use. We also use them in predicting the price movement. So you will see people adding some kind of additional things to their charts, like moving average, RSI. There's a relative strength index, the Bollinger Bands. They are called the indicators. So let me put this back at daily. So this is where you can find indicators. So there's different kind of indicators that you can, but indicators are lagging. They don't show. They show current price that has, it's not showing the future. It's showing the past, right? So let me use moving average as an example. I'm using a simple moving average as an example. This is I can't access indicators because this is a free trading view. I'm not aware of that. Let me try to use RSI. So I think there's been an upgrade. I can't access all these indicators. So I wasn't aware of that before. But indicators are just like additional, confluences. Can give you additional confluence to predict price movement. So that's what indicators is about. I would have shown you because it's better when I show you to know what they are. So I personally don't like using indicators because they are lagging, but it's one of the tools used in predicting the market. So, and these are just a few that have been mentioned here. And yeah, and there are a lot more. There's a lot of indicators. So I'll move on to chart patterns. So when we talk about chart patterns, it's just like some patterns that you can identify on your chart. So as for some few examples is head and shoulder, double top or bottom, flag and pennant. So don't let all these words scare you. They are just simple trends that you can just identify on your chart. So we'll go deeply into this when we talk about chart patterns. So yeah, chart patterns. So moving on, talk about risk management. So basically it's just how you can manage your capital very well. So there might be there you might have had a lot of misconception that trading is risky, it can take all your money and all that, but when you're disciplined and you have uh a strict risk percentage, you will be fine, right? So you can have one example, you have a 10,000, or let me say a $1,000 account now, capital in your account, and you decide that I want to risk 2% of $1,000, like 2% of my capital on each trade, right? So that means you're deciding that you want to risk $20 per trade. So you have about 50 opportunities to take trade before you even blow off your capital. So having a risk percentage helps you to manage your capital very well. So maximum risk per trade is just limiting loss to a certain percentage of the total capital. So you can have a percentage. I think the advisable one is using 1 to 2% of your trading capital per trade. Then we have diversification. It's spreading capital across different financial instruments and markets to reduce risk. So instead of putting all your eggs in one basket, you can decide uh, to pick some few assets you want to be trading, and you know allocate your capital among them. So even if some are not some did not yield is not yielding profit, some will yield profit. So instead of putting all your egg in one basket, which there's a risk you might lose it all, you can spread it among different financial instruments. And I'll also talk about the stop loss strategy. So stop loss, as I've mentioned earlier, is just to help you limit your loss, to reduce your risk, right? So you can have a fixed stop loss. Example, the price, maybe the current market price of an asset is $4, and then my my stop loss is at $3, right? And my target is at $10. So if the market goes to my target, I'm going to be earning about $6. But if it didn't go in my favor, because my stop loss is at $3, I will be losing just $1. So the current market price is $4 and my stop loss is at $3. So what I'm going to be losing is just $1. So that's the fixed stop loss. Just setting a fixed stop loss. And another one you should know is trailing stop loss. So it's a dynamic stop loss that follow price and secure profits while limiting losses. So assuming I enter a trade at $4 and it moves up to like $6, and my initial stop loss is at $3, I could decide to move my stop loss to about $5, so that even if it reverses, it will hit my trailing stop loss, my stop loss, which is above my entry price already. So I could still gain something, right? Because I'm stopped out now at a price that is above my entry price. And let's say the market move up to like $9, and then you decide to shift your stop loss again from 5 to like 7, right? So and the market starts to retrace and it's the $7, you could see that you would still profit, yeah, from the market movement. So you entered at 4, now you are being stopped out by at $7. So you didn't lose anything. As a matter of fact, you gain $30 more. So that's what trailing stop loss is basically about. It's just like always adjusting your stop loss with price as price goes up. And it could be that it's just the same thing as if you are shorting the market. If you are trying to sell, you just, as market is selling, you just be changing your stop loss accordingly, just to make sure that you're not losing anything, right? Okay, so I'll briefly talk about trading psychology. So um psychology, is a very important aspect of trading, very very important even than your technical analysis. So I feel like 80% of what trading is about is the psychology aspect. So we'll be talking about this very deeply in our subsequent classes. So and we'll be taking each topic one by one anyways. So there's a kind of behavior you have to like put on when you're trading. I mean, you have to be able to keep your emotions in check, because when it comes to trading there are some emotions that are revealed, like fear, greed, I don't know, fear and greed, and many more, anger, all those emotions. You have to be able to keep it in check. You don't want to be trading with your emotions, because by that you make bad decisions. So discipline is sticking to your plan and avoiding impulsive decisions. So you want to be able to stick to your trading plan and avoid decisions that are just not planned for. Unplanned decision, you just want to take it because you felt like, we're not trading feelings here, we are trading plan, a strict plan. So you would be disciplined and patient. I think this is the two main behavior you have to like put in place when you're trading. So patience, you have to be able to wait for the right opportunity and not forcing trades. So discipline and patience will is a very very important uh trading behavior you have to like learn over time. So we'll talk more on that on trading psychology, and also we'll talk about dealing with losses. How do you deal with losses? you know Losses are normal part of trading and it shouldn't scare you. As long as you're managing your risks properly, then you shouldn't have a problem. But you should learn how to accept loss, because losses are part of trading and it should be viewed as learning experiences, right? So you have to like be able to accept your loss, learn from it, not make your loss make you feel very down and very sad. No, you should be able to accept loss and move forward from it. And adjustments also, analyzing your mistake and adjusting your strategies accordingly. You should be able to like go over your losses, go over the trade that resulted into losses, and learn from it, right, and move forward. So learning from your mistake will help you not to keep repeating the same mistakes. So lastly, I'll talk about opening a trading account, right? So how to choose the right broker. So you should choose the right, because the a broker is, a link between you and the market. They're the ones that help you execute your trade. So you have to get a broker and get the right trading platforms too you would need for trading. So trying to educate you on all those things. So, and the things you have to consider before choosing a broker, because there are a lot of brokers, regulated and not regulated. But you will be doing a mistake by just choosing any type of broker without even doing your research. So you have to choose a broker that is regulated by a recognized financial authority. So you have to choose a broker that is regulated and recognized. So you have to like do your research. This regulation is very important, right? So there's some news I heard recently that there are certain brokers, they're popular and they are being banned because of their regulation. So you have to do your research very well, because if you don't and put your money in any type of broker, you will pay for it, like some. So, and the fee structure, you pay attention to their trading fees, their spread and their cost. So the minimum capital that they accept, their spread. So spread is just the difference between the ask and the bid price. We'll talk about that um later. So if the spread is too wide, it's very bad for you. So the spread should be as a very very tight, right? You want a broker that offer a very tight spread. And other costs, so there can be other costs like that are so ambiguous that might just cost you so much. So you have to check if your broker has your best interest at heart. So we have also trading platforms. So let me first talk about the brokers. So personally, I use Derive. Yeah, Derive. That's the broker that I use, and I recommend it anytime and any day because they are regulated and a very good broker. There's also SNES. So you could choose to open an account with them. So I'm very familiar with Derive and SNES. That is why I'm mentioning that. But there are many other brokers, right? Many others, like just a lot. XM, Pepperstone, all that. There are a lot of brokers. But just do your research before opening an account with any of this broker. So uh so I think there will be a link below this video that can direct you to where you can create an account. So if you want to create a Derive account, there will be a link below this video and you click on it and you create a Derive account. So also, trading platform, ensure that the platform is user friendly and offer necessary tools and features. So the broker that you're choosing, ensure that they offer a good trading platform, like their trading platform is user friendly. Like I can say about Derive, their trading platform is MT5 and it is so smooth, user friendly and stress free, right? So you can do research on which trading platform is your broker offering to. All right, so last but not the least is the demo account, right? As a beginner, you have no business in with depositing money in your trading account right now. What you should focus on is learning, and also you could create a demo account, very important, and help you get familiar with trading platform, help you to test your trading strategy and just get you familiar, because a trading when you have a demo account, you are not trading with your real money. So you're just trading with paper currency, right? So you use that to practice for some months, right? So just be patient and give yourself a longer time frame. You don't have to rush anything. You don't have to, you don't have to like be a professional trader just after reading this, watching this video. So there's no rush. Just view trading as if you're going to school to get a degree, right? So and the average year you can use to get any degree is 4 years. So be patient. And also, limitation. Remember that demo account does not reflect emotion aspects of live trading. So demo account is just for you to practice, right? So it's when you upgrade to the live account that you have to deal with emotions, because when you're trading demo account, there's no emotions involved, right? So that's it. So you create a demo account, very important, and use it to practice. All right, so that will be all. So this is just a conclusion. You could just keep learning continuously and get education from the right sources anyways. So you can get online courses and webinars to improve your knowledge and make you understand things better. And also you can join various trading communities and forums, at least the ones that have your best interest at heart, right? So, and you learn from other traders, you see how other traders are doing, learn from people that are better than you, right? So you can join other traders trading community. So trading is a very lucrative and rewarding and also exciting activity. So and it's required discipline, knowledge, continuous learning, and most importantly patience. So I think this book has been able to like introduce you to some basic aspects, like basic terminologies on trading, and it won't be it won't be strange to you in our subsequent class when I start using some of this terminology. And I would be going into everything deeply in our subsequent classes. Each of these topics, I will be taking them as a like a subtopic, right? So as I've said, this is just an introduction and helping you to like know little knowledge about what trading is. So I believe you have been able to get some understanding on the basics of forex, of trading, of trading in general. So I will see you in my next class. So the task for today is for you to give me a summary of everything that you have learned today. So as we proceed, the tasks will become more and more complex. Not so complex, but you would understand. It won't be a problem for you. So that will be all. I'll see you in my next class. Thank you.